Why not choose only growth over dividend investments? So you've decided to take control of your financial future and start investing today, ensuring you're prepared for retirement. But now you're faced with a critical choice. Should you focus on dividend income to sustain your lifestyle over the next 30 years? Or bet on growth investments for potentially bigger returns? Maybe you've heard the argument, why worry about dividends when selling shares can provide the same income? Don't commit just yet. If you are torn between growth stocks and dividend investments, this video is just what you need. We will dive deep into the debate, breaking down what dividends truly are and why they still matter. Beyond just cashing out shares, we will also tackle the big question of why you shouldn't go all in on growth stocks, even though they often outperform dividend investments. By the end, we will uncover the pros and cons of each approach and then share our proven strategy to help you make the best choice for your financial future. How dividends work. Dividends are payments made by a company to its shareholders, typically as a portion of the company's profits. Dividends are one of the most common ways companies distribute their profits to shareholders. Instead of reinvesting all their earnings back into the business, companies often decide to share a portion with their investors as a reward for their support and investment. These payments are usually distributed in cash, though some companies offer dividends in the form of additional shares of stock. But of course, not all companies pay dividends. A company might decide to use its profits to fund growth initiatives like research and development, acquisitions, or expansion. But as a shareholder receiving dividends, you can 1. Use dividends as income. For many investors, especially retirees, dividends serve as a reliable source of income. Instead of selling shares to cover expenses, they can rely on these periodic payments to support their lifestyle. 2. Reinvest in another opportunity. You certainly don't have to stick with the company that issued the dividends. You can use the cash to invest in other companies, sectors, or asset classes, diversifying your portfolio and seizing new growth opportunities. 3. Reinvest in the same company. Many companies offer dividend reinvestment plans, DRIP for short. These allow shareholders to automatically use their dividends to purchase more shares of the same stock. This approach compounds your investment over time, especially in companies with a history of growing dividends. How dividends impact stock prices. Dividends can seem a bit confusing when you first start investing. Not only do they represent a direct cash payment to shareholders, but they also influence the stock's price in ways that may surprise you. Let's take this real-life scenario. Imagine you're tracking a stock on January 2nd that's trading at $100 per share. Then the company announces $5 in excess cash per share from earnings. They decide to keep $1 per share for reinvestment and then pay $4 per share as a dividend to shareholders who own the stock by January 12th. The key date to watch is the ex-dividend date, January 10th. To receive the $4 dividend, you must own the stock before this date. So, what happens to the stock price? Before the ex-dividend date, January 9th, the stock might trade at $105, reflecting $100 for the company's core value, $1 in new retained earnings, $4 for the upcoming dividend. On the ex-dividend date, on January 10th, the price drops to $101, accounting for the $4 dividend that new buyers won't receive. The question now is, why does this matter? You see, the price drop simply reflects the dividend payment leaving the company. Shareholders get the $4 in cash but keep their shares, which can continue to grow in value. Therefore, dividends aren't free money. They're a slice of the company's profits taken out of the stock price and handed to you. It's the company's way of letting you decide how to use that portion, spend, reinvest, or invest elsewhere. The choice is yours. Taxes on dividends? That's just the cost of the flexibility you get. Remember, dividends are a powerful way to generate income or reinvest for growth, and merely understanding their impact on stock prices helps you make smarter decisions. Why not just sell shares for cash? Supporters of growth stocks often argue that dividends are unnecessary. You will hear them say you can always sell shares when you need cash. Technically, they're right. But here's the catch. Selling shares leaves you at the mercy of market timing, tax implications, and most critically, the roller coaster of volatile stock prices. Let's explain. 1. Market timing. Have in mind that when selling shares for cash, the price you get depends on market conditions. If the market is down, you might have to sell more shares than expected, shrinking your investment faster than planned. 2. Tax implications. Selling shares often triggers capital gains tax, which can be higher than the tax on dividends, especially if the shares are sold within a year. You certainly don't want this eating into your returns. 3. Volatile stock prices. Stock prices can fluctuate wildly. Relying on selling shares for cash means you could be forced to sell during a dip and lock in losses. Dividends, on the other hand, offer steady, predictable cash flow without having to sell a single share. It's the difference between waiting for the market to cooperate and having a reliable income stream on your terms. In a real-life scenario, let's picture this. It's March 2020. The market has plunged to its lowest point during the lockdown, and you need cash for living expenses. You're forced to sell your shares right when you should be buying at bargain prices. Now imagine a different scenario. Instead of selling shares, you rely on steady, predictable dividend payments. No panic, no bad timing, just a reliable income stream that helps you cover your needs without worrying about market chaos. That's the power of dividends. They give you control, even when the market feels out of control. Owning dividend stocks is like being a silent partner in a business. You get a share of the profits without ever having to sell your stake. It's a mindset shift, one where your wealth grows steadily over time, just like a business generating consistent income. This approach isn't for everyone, but for those who seek stability and long-term growth, it offers a solid foundation for building wealth without the stress of constantly buying and selling. Over the long term, growth stocks always outperform the dividend stocks. Many argue that paying dividends is a sign the company doesn't know how to reinvest its profits for growth. Instead of using that money to expand the business, they just give it back to shareholders to do with it as they please. The downside? In the long run, dividend stocks tend to have less growth potential and often lag behind growth stocks. Now let's tackle the argument using data from two Schwab funds. Schwab US Dividend Equity ETF, SCHD, as representative of Dividend ETF. Schwab US Large Cap Growth ETF, SCHG, as representative of Growth ETF. Below is the total return with dividends reinvested of SCHD compared to SCHG since 2014. SCHD is a fund that focuses on paying you dividends, which is like getting a small reward from the company for owning their stock. It offers a 3.89% dividend yield and has grown at an 11% annual return since 2014. That means if you invested $1,000, it would grow to $3,180 in 10 years, thanks to both the price increase and the dividends you've reinvested. On the other hand, SCHG focuses on growth, so it pays a much smaller 0.45% dividend, but grows at an impressive 16.44% annual return. Your $1,000 would grow to $5,403 in 10 years with this fund. While growth funds tend to give better returns over time, investing isn't just about the numbers. As you can see, growth funds do give you more money, but their prices can jump up and down a lot. This can lead to emotional decisions like selling when the price drops or buying when it's too high. In fact, research shows that about 70% of investors make impulsive choices they regret later. So it's not only about which fund grows more, it's also about how comfortable you are with the ups and downs. Let's take Facebook, Meta, as an example. If you bought it 5 years ago at $195 per share, you'd be sitting on a 200% gain today, with the stock now at $585. Pretty impressive, right? But hold on. During those 5 years, you would have also seen the stock drop to $148 at one point, which is a 24% loss in just a year. Then it bounced back to $382, nearly doubling your investment. But of course, it didn't stop there. The next year, it plummeted to $88, causing a 55% loss. Yikes! Even though the stock has rallied back to $585 today, The emotional roller coaster along the way could have led many investors to panic and sell too soon. It's easy to look back and say, "Wow, I should have held on." But in reality, sticking with a stock through those price swings is much harder than it seems. And remember, this is just a 5-year period. Imagine dealing with this kind of volatility for 20 or 30 years while saving for retirement. Those ups and downs would make it way harder to stay the course. Now, dividend stocks also experience price swings due to market changes. But here's the key difference. The steady, growing dividend payments over time can help reduce anxiety. You get a predictable income stream that keeps growing, which makes it easier to ignore the short-term market volatility. You're less likely to make emotional decisions based on daily price drops. So while dividends don't eliminate the roller coaster, they can help you stay calm and focused on the long-term goal. Our strategy. So, growth or dividend stocks? The good news is, you don't have to pick just one approach. Both have their perks and drawbacks. Our strategy? Mix the best of both worlds. If you're planning for retirement in, say, 30 years, it makes sense to add growth funds to your retirement account. You're looking for that growth exposure over time, so just keep adding to it without worrying too much. The market's ups and downs won't bother you as much, and it reduces the chance of making emotional decisions when things get rocky. Now, to complement that, we also build a dividend portfolio. But here's the twist. Dividend investing isn't about chasing the highest returns. It's about creating a reliable, steady income stream to cover your daily expenses. Plus, it keeps you focused on the long-term goal, showing you that you're making progress with growing income over time, no matter what the stock price is doing. How does having the best of both worlds sound? By combining them with our strategy, you can enjoy the power of long-term growth while having the stability of consistent income along the way. This balance helps you stay on track, reduce emotional decisions, and build wealth that grows steadily, whether the market is up or down. So take a page from our playbook and start blending growth and dividend stocks to create a strategy that works for you, no matter what your financial goals are. You've got this. Now go make your money work for you. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.